Welcome, everyone, to another edition of Mining Metrics, which is a live show and a collaboration between Compass Mining and Luxor. Kaan, thank you for hopping in. Before we hopped on here, we were talking about some of the snow that's been accumulating up in your end of the area. How much snow did y'all get? Because I think you're up in the Toronto area.
Yeah, correct. I don't know by measurement, but I can definitely say a ton of snow. Enough for me to wish I had some home mining devices with me right now.
Oh, yeah. I don't know if you were able to catch last night. We had an X Space and we had Tyler Stevens on, and Tyler Stevens has just launched the the Bitcoin mining heat reuse kind of like manifesto. And I hope that you can get a copy up there because I know you guys are going to be interested in that. But when we were talking about that, yeah, I think everyone who's been dealing with the cold and dealing with snow is like, yeah, it is time to think about how we can bring mining home, as Tyler says. So I know we're not going to probably be talking about home mining today, but it feels super salient when you have so much snow. And I was telling you that I have family up in Vermont, and they got 2.5 feet of snow, which is close to a meter. I don't know, 80 centimeters or whatever, 85 centimeters in 24, 36 hours. That is a good amount of snow. So we're definitely feeling winter finally, because it's, being up in Boston when I'm stateside, we haven't had snow like that in a very, very long time. There was in 2014, Boston got killed. It had like crazy amounts of snow. It was like snowmageddon, I think they call it. But it's been a while, so I think snow is generally good. I know skiers and snowboarders are enjoying it. So anyways, enough with the weather small talk. I'm going to hand it over to you and we can get going. If you're joining and you have a comment, whether you're watching on X, LinkedIn, or YouTube, go ahead and leave the comment below. If you're on X, just leave a comment on the feed. If you're on LinkedIn, leave a comment below on the live feed, and YouTube the same. Just leave a comment where you leave comments on YouTube, and we'll be able to see it, and we will address it when we can. We sometimes keep comments for the end, but I'll be MC, and if it makes sense to share, we'll go ahead and do that. So, Kaan, I'm going to go ahead, change screens here, and give you the mic.
Absolutely. Thanks so much, Jarrett. So let's get going for February 2025. Agenda for today, as usual, we'll go through a TLDR. We'll then dive into our specific sections. Starting off with mining economics, we'll look into hash price and its constituents. We'll then take a look at hardware markets, talk a little bit about ASICs. We'll then take a look at what the PubCos are up to. And then finally, we'll finish off with some forward-looking insights, which we can derive from our forward hash rate markets. So starting off, TLDR for February 2025. Well, actually, 2025 so far, since it's only been a month and a bit. So first of all, slow box. We had an Arctic blast in January, which led to a surge in demand for natural gas and consequently power prices across the US. Naturally, this resulted in curtailments, which reduced hash rate and caused the first drop in network difficulty we've seen since September of 2024. Second, low fees. In Bitcoin terms, monthly average transaction fees per block continue to go down and down and down. And right now we're at around the lowest levels we've seen since April of 2012. In US dollar terms, the picture is a little different, but still disappointing. We see transaction fee collection roughly in line still with averages observed throughout the third quarter of 2024. Hedging, hash rate hedging, is a concept that we'll touch on for today's session as well. So far, what we've seen is that generally, over the past 6 months or so, the best strategy for mining companies has been to hedge network difficulty and transaction fees specifically. And the way you can achieve this is by selling forward in the Bitcoin-denominated hash rate market, which allows you to maintain long exposure to Bitcoin, but hedge against these hash price constituents, which we'll take a look at. And finally, there are headwinds in the hardware space. We know that tariffs are an ongoing conversation between the US and the rest of the world right now. And this for sure could increase the cost of mining hardware, which can potentially reduce future hash rate growth rates.
We have a comment, just want to shout out here from April, said, "Hey guys, happy mining. Hey April, hope you're doing well. Just figured I'd call that out. Continue, please."
Welcome, April. Happy hashing. All right, let's get into it. Hash price constituents. So big picture, Bitcoin miners still continue to face a challenging hash price environment. But to put this into context, let's take a look at some numbers over the past 6 months or so. So in August and September of last year, 2024, was when we saw the two lowest hash price prints on record since 2017. And this was around the $43 mark. What we see here is hash price and its constituents ranging from November of 2024 to February of 2025. So we can see that things got a little bit better over that time as we got into the second half of 2024 and as we came into 2025 as well. So in January, Bitcoin's monthly average price and network difficulty reached new all-time highs for the third consecutive month. We can see this growing across the rows in terms of network difficulty. There's a lot of red, which means it's always increasing. Bitcoin price action has somewhat slowed down between January and February, but up until then, we know that Bitcoin had a pretty strong rally. And then transaction fees are telling us the exact opposite. They continue to be depressed and are going down and down and down. Right now, transaction fees are essentially bone dry. On the whole, average USD hash price declined by 3% in January, and so far, the average we've seen throughout the month of February is around 55.77, which is a little lower than the average we've seen throughout January as well. Bitcoin price action throughout February has been range bound. Network difficulty continues to climb, and transaction fees, as we mentioned, are essentially dry. Now, similar to December and January, Bitcoin price action was relatively range bound throughout 2025 and also throughout February as well. Essentially, we've seen Bitcoin hover anywhere around $93,000 to $105,000 US. Bitcoin began the year at just below 94,000, ended January at 104,000, and the daily average price for February that we've seen so far is 97,500, which is around 2.5% down from January's average number. Network difficulty, on the other hand, also reached an all-time high on a monthly average basis in January of 2025, but it actually declined over the course of January, and we'll get into why this is the case. So difficulty began the month at 109.78 trillion, increased to 110.45 trillion, following an upwards adjustment on the 12th of January. However, we saw a negative downward adjustment of 2.12% on January 26th. This was the first since September of 2024, which brought difficulty down to 108.11 trillion. So on a monthly total, difficulty actually declined by 1.5% throughout January 2025. We then obviously see this big subsequent upward adjustment, which took place on February 9th, and that was over a 5.6% upwards adjustment. Now, why is this the case? What happened? Speaking of snow, Jarrett, the reason is that cold weather in the United States moved hash rate markets in January. So temperatures fell due to an Arctic blast, which sharply increased natural gas demand for heating and for power. And what this chart shows here is the average temperature per epoch and average power price per epoch in different regions in the US. You can see that as temperatures go down, power price for natural gas is going up. So natural gas prices surged, particularly in the Northeast, which reflected strains on supply from this cold snap that we saw. Higher natural gas prices directly translated to higher electricity costs. So in total, we have rising fuel costs, higher demand, and reduced supply, which all ended up driving up power prices across central and eastern markets during the mining difficulty epoch from the 13th to the 26th of January. What does this mean? Well, higher power prices mean that there are more uneconomic mining hours that mining operations experience throughout the day. And this is because the cold weather is driving up energy costs, which will reduce mining downtime. And that's what we see here. This chart here shows Luxor's estimates for uneconomic mining hours, which means periods of negative gross mining margins. And we built this chart based on real-time power prices, hash price, and an assumption for hardware efficiency, which we assume the global network efficiency to be around 25.5 joules per terahash for this calculation. What we can see is that the sharp rise in uneconomic mining hours during the mining epoch from January 13 to 26 was a key factor in the difficulty decline, given that the US and Texas specifically account for an estimated 36% and 17% of the global hash rate, respectively. So clearly, the data shows that this cold snap had a temporary effect on hash rate markets. And this is a signal for some seasonality that we can see in the Bitcoin mining sector at different times throughout the year. Obviously, we would expect this trend to reverse as temperatures, power prices, and mining uptime return to baseline, which is exactly what we saw and why we saw this significant 5.5% increase in difficulty on the 9th of February as this situation reverted back to the mean.
Yeah, just looking at that red, you cannot not look at that red candle there. So between January 13th to January 2026, in a 14-day period, there's going to be 336 hours. And that's basically saying 90 hours were not profitable, which is, it's close enough. I'm going to round and people can hold that against me, but it's about a quarter of the time it was not profitable to mine Bitcoin, which is a lot of time. If you think about, losing 8 hours every day, not being able to profitably mine Bitcoin, that is a true impact right there.
Absolutely. And this is exactly what we see. And the way that the network responds and adapts to this is by the difficulty adjustment, lowering the difficulty so that we can self-regulate and come back to 10-minute block intervals as expected. So now turning to transaction fees. As we always mention, transaction fees are highly volatile and unpredictable. What we see so far is after a second half of 2024, which was weak for transaction fees, this trend has continued on into 2025 so far. In Bitcoin terms, transaction fees per block per day throughout January 2025 averaged 0.046 Bitcoin, which is a 47% drop compared to December's numbers. And it puts us around the lowest monthly level since April of 2012, which is nearly 13 years ago. In February, so far, average transaction fees collected, again, per block per day, is even lower, in fact, 28% lower at 0.033 Bitcoin. So safe to say that right now, transaction fees are absolutely bone dry. If we now zoom out and take a different perspective on transaction fees and observe it in USD terms, the picture is slightly different, but still relatively disappointing. So if we adjust for the monthly average Bitcoin price, average transaction fees collected per block in January per day was $4,600, which is actually roughly in line with average fee collection we observed throughout the third quarter of 2024. So even though on a Bitcoin basis, obviously transaction fees are minimal at this stage, the USD exchange rate between Bitcoin and the US dollar, i.e. the Bitcoin price, somewhat makes up for this. But again, it really depends on what you're essentially optimizing for as a Bitcoin miner. If you want to collect the maximal amount of fees that you can and measure your revenues in Bitcoin denominations versus USD, then you can see a bit of a different picture.
I want to ask for some clarification here and just make sure I'm right. The farthest left extreme of our range here is January 2017, and then the farthest right is January of 2025. Is that right? Just because if people are watching this on X, I just zoomed in a little bit. I think I could see it. Is that right?
Correct. Yes.
So this makes, now this makes sense because in January, the price for Bitcoin, the average was, I think you said, let's just say somewhere around 97, 98,
Correct.
99,000.
Yep.
And I just looked up the average price of Bitcoin in January 2017 was 920. So we're at almost 100x
Yeah.
in the range, in the 8-year range that you're looking at here. And for anyone who's also in the class of 2017, like myself, that was a different time.
Absolutely. That was definitely a different time.
Definitely a different time.
So here's another data point to further show the case around transaction fees. We know that fees are determined by demand for block space. And in January, that demand, which can be measured by total on-chain transaction frequency and the mempool size, essentially returned to pre-ordinal or BRC20 or runes levels, i.e. levels that we saw back in early 2023. In fact, on February 1st of 2025, so earlier this month, the mempool cleared for the first time since April of 2023. This is a big deal. When the mempool clears, it means that all pending transactions have been confirmed. And there are two instances when this could happen. The first is when block space exceeds demand. In other words, more transactions are being confirmed in each block than are being broadcast to the network and collected in the mempool. And then the second is just low network activity. Essentially, fewer users are making transactions on chain, which means that miners have caught up on all pending transactions to the point where there are no pending transactions left. This is clearly significant for miners. The reason is because when the mempool is empty, transaction fees obviously drop significantly. You're not collecting any fees, which reduces profitability for miners and affects hash price. If fees are near zero, essentially miners rely solely on the block subsidy, which again is indicative of low network activity. So a cleared mempool may suggest less activity going on in Bitcoin, which may or may not reflect lower demand for on-chain transactions.
Seeing this is like, if you're a Bitcoiner and you're looking at this and hearing everything you just said, it really makes sense because it feels like we're in a moment where the price is just yo-yoing. And you already said, the average is somewhere between, I don't know, 93 to 104 for the past 9, 10, 12 weeks almost. And while the news is super bullish, because every day you could open up X, stone throw, just throw a stone on X, and you're going to see something about Michael Saylor raising more money to buy Bitcoin. Or there'll be pretty bullish news, a sovereign like the Czech Republic, I think, said if you hold Bitcoin longer than 3 years, then there's no capital gains. That's an extremely bullish news thing, but it just doesn't seem to move the needle. And part of me wonders, and once again, I'm actually not sure about this, so I'm going to say something that may not. I'm just kind of asking. When the ETFs buy, right? Do they just buy, say, $1 billion of Bitcoin? And that could be representative of 10,000 Bitcoiners or 100,000 Bitcoiners that all buy Bitcoin, but then they only buy one. So I guess one of the questions I have is, if that is the case, and that's how ETF, and if someone wants to leave a comment, please, I'd be interested. But if that's how the ETFs do clear at the end of the day or whenever they buy or every hour, it's different than the past potential demand for block space, just because you could have hundreds of people that put their money in, buy the ETF, and BlackRock and the IBIT goes out and buys it once an hour, or even once a day. And that's just reducing the demand on block space as opposed to where it was in 2017, where there wasn't that. And if you wanted Bitcoin or exposure to Bitcoin price action, you couldn't get a synthetic product like an ETF. You had to literally go get the thing from the, from the network. So part of me is asking that out loud. And I wonder how that plays a part, because I do think the ETFs are changing the way that we engage with the Bitcoin network. And also as a way to say, you and I sit around, someone says, hey, how many people own Bitcoin? Well, we can go look on chain. But that now, because of the way people think of the ETF, and Plan B the other day turning in all of his Bitcoin for the ETF. And I don't think we have enough time to talk about what that means, but it's just kind of interesting to see how the ETF may play a role in block demand. But once again, I'm actually not sure. But the story in my head is, even if they're buying once every 10 minutes or once every hour, it's still reducing the demand, as opposed to having those hundred thousands of people who are maybe taking, DCAing into Bitcoin. by doing it through the ETF, I wonder if it does reduce block demand, and if this will be a trend that we see continue as more ETFs are launched around the world, Bitcoin ETFs. So just throwing that out there.
It's an interesting question. There's two comments that I would make. One is there's almost a naturally opposing force between institutional activity on Bitcoin on chain and retail activity. The reason being is obviously institutional activity is representative of more adoption and integration between Wall Street and traditional finance and Bitcoin, as well as some of the TradFi activity moves on chain and shows itself through on chain transactions. But then on the other hand, when it comes to the individual, their use case for Bitcoin may be different, and they may have a completely different goal with why they are participating in Bitcoin. They may just choose to hold and not rely on the blockchain for executing financial transactions. It might just be a savings mechanism for them instead. So there's that side. And then from a protocol development perspective, the open nature of Bitcoin is driving innovation. And as the software developer community continues to participate, they're trying to make Bitcoin ever more efficient. So perhaps BIPs have a role to play here. Some of the changes in activity and behavior in block space and transaction fee markets, we are starting to consider as perhaps indicative of a more fundamental change in people's use case for the blockchain. So it's an open question, and it's something that we are paying careful attention to because we do see that something has changed.
Yeah, something has changed, and it feels like is changing currently. In like, seeing the mempool being cleared at a time once again where it seems like there's so much bullish news around Bitcoin adoption, both from a sovereign level to local, to everyone who's listening to this knows someone who has come into Bitcoin in the last 3 to 6 months and like really put some time in. I have a good friend who's gotten over one Bitcoin now. The amount of wallets that have that, or the amount of people that have that, I think it's less than 1 million. So we're kind of in this weird world where it's like the hype and the news does not match what I see happening in at the protocol level. And that's a disassociation I don't know if it's necessarily happened before, but it's fascinating to watch. And this is the graphic I think that really speaks to it.
Absolutely. Yeah. So definitely something to keep an eye out on. Okay, we'll now move to our hardware section. So we've introduced this hash cost table before, but just to remind the audience, essentially what this curve shows us is based off of our specific mining operation, to what extent we could justify hashing at a particular combination of electricity prices and overall fleet efficiency. So that is essentially our cost curve. Any green space here means that we're in the green, we should be operating, and our machines should be turned on and hashing. And anywhere in the red essentially means that this is where we decide to turn off, because the revenue that we generate from having our machines online and hashing doesn't justify the costs that we incur in doing that. So we mentioned over the past 4 months, hash price has tended to be around the $55 to $60 range. And this is essentially what the mining sector has experienced in terms of economics. So we see that the curve is moving just a little bit, but it's essentially oscillating around the same area. And all of this is determined by hash price, which takes into account Bitcoin price, network difficulty, and transaction fees. So all in all, the hash price environment over the past few months has been relatively stable and relatively more healthier compared to the immediate months right after the halving, which was in April of 2024. Now, taking a look at popular ASICs, which machines are selling these days? Jarrett, through our previous episodes, we've touched on a wide range of concepts around the ASIC purchase decision and how to think about ASICs in terms of investments, return profiles, etc. And a big observation, which came out of our year-end 2024 report, which we covered in our last episode, was the consistent premium that we were seeing for new generation machines, for example, the S21 series by Bitmain. And we can see this still shown in our data. This is data that we got from our ASIC trading and brokerage desk, essentially showing buy-side demand in our marketplace for ASICs throughout the month of January 2025. We see a few spikes stand out here, most notably the 21 series, 21 Pro, and the Vanilla 21 by Bitmain, alongside the 19 series, specifically the XP, the J Pro, and the 19 Pro. We've touched on this before as well. We know that because of current hash price and mining economics conditions, the S19 series machines have entailed relatively short payback periods, which is why they've been in demand over the past few months or so. So, yeah, those are two big insights that we can see. And then we can also see the same thing show up on competing manufacturers as well. For example, with MicroBT's WhatsMiner series, we see the M30Ss, the 50, and the 60 series all in high demand as well. So I'll pause here for a minute. Do you have anything you want to share?
Yeah, this is another unbelievable graphic. And I know that there's a lot of people in the hardware world that are just going to look at this and, it's going to either align with something that they believe, or it's going to be kind of, maybe test some limiting beliefs around the hardware that is in demand. One of the things I wanted to share with you is on the podcast that we actually published just yesterday with Adam Budd, who's one of our, main sales associates. He was talking about how he has 3 S19 XPs. He just got them online. He's hosting them with Compass. And one of the interesting things he said was, he's doing the math at how much Bitcoin he's going to get per week. And he basically is going to get the same amount of Bitcoin per week that would be the block reward, I think in like 2060 something. I'm not sure. It was 62, 64, or 66. I'm going to mess that math up. But basically, he's getting a block reward 40 years in the future every week with only having 3 S19 XPs online, which I just think is exceedingly bullish, because just for the overall terahash that you have there, you could get a couple of the maybe newer generation miners, and you're going to start to do that. And that was a brand new way that I started to think about mining, which is like, man, if you can get a block reward from 40 years into the future every week with your mining setup, that's pretty great. Every time you add one, maybe you're coming down an epoch. Maybe it's not 40 years out, maybe it's 36 years out, and every miner you get online. So for people that are watching this and wondering, is now the time to be mining, I will say, try to find that on our YouTube, on Compass's YouTube, or on Compass's. You can find us on Spotify or Apple. He does a really great job breaking down the mining economics around the hardware, but also around the moment. Even taking into account some of the things that we've talked about, and you've been very transparent about. Hey, this isn't the most exciting thing, right? Hash price isn't where we necessarily want it to be. The fact that we're not getting transaction fees, that's not necessarily something we're excited about. But even within that environment, there's still ways to be profitable with mining. So I think it's just exciting. But I wanted to call it out because I have S19 XPs living in my mind for free that he had mentioned. So I just wanted to, kind of call that out on this graphic.
Absolutely. That's a very unique perspective, and I really like it because it is a long-term perspective and goes to show the nature of the game that is Bitcoin mining. Awesome. So taking a look now at some price trends for used ASICs. This touches again on what we just discussed now, Jarrett, really is around older generation machines still being relatively attractive simply because of the payback involved and the combination of having the right mining economics conditions at this moment, which may justify purchases of these machines. So, yeah, clearly they are still in demand, and prices are at relatively attractive rates at the moment, which means that all the stars are somewhat aligned to be purchasing and plugging in relatively old generation ASICs at the moment.
Yeah, and just a question: when do you know? And I can look it up while we look at the next slide. But I'm just curious when the M30S plus plus and the M30S plus, like what years are we talking? In my head, it's like 2018, 2019, but maybe it's not that far back. Do you know?
That's a good question. I don't know off the top of my head, but they are comparable to the 19 series for Bitmain.
Okay, cool.
Yeah, so they're around the same neighborhood in terms of pricing, performance, efficiency, etc. So I would compare them to the 19 series.
Nice. Yeah, and I see the one outlier here is the S19 XP that I was just calling out that Adam was talking about how he got 3 up online, and you can see it's getting close to that $10 per terahash. But that's, if as we said on the podcast the other day, and I think people understand in mining who are around in 2021, if there's a hardware demand squeeze, if there's other supply chain logistics, we don't know necessarily what the U.S. government wants to do with tariffs for stuff coming in from China. There are reasons right now to consider definitely getting some hash online.
Absolutely. All right, now moving on to public markets. So we'll keep this section brief, but I think there's a few interesting concepts that we can touch on, which is topical and relevant at the moment for publicly traded Bitcoin miners. The first is the changing nature of shareholders in public Bitcoin mining companies. So this was an article that was written by our friends over at Blockspace Media. It actually came out earlier today. And I think it's interesting because what it shows is the significant ownership stakes that institutional investors have in major Bitcoin mining companies. In fact, Wall Street institutions, traditional finance institutions, now collectively own approximately 40% of outstanding shares in leading Bitcoin mining companies, which is a big change and indicates a strong institutional presence in the mining sector from a financial markets perspective. So this is a new trend, I think, which reflects growing confidence and investment from the TradFi world into the Bitcoin and Bitcoin mining industries.
Yeah, I mean, wow. I hadn't seen this. This is obviously from Will and the good people over at Blockspace, but that is staggering that from what I understand, looking at this, Core Scientific, 85% of Core Scientific is owned by institutions. That's what we're
Exactly.
saying?
Yes, that's
That's
correct.
ridiculous. That's ridiculous.
Yeah.
Having 17 out of 20 shares owned by them is just such a bullish signal. BlackRock's not going to invest in something that they don't think is not part of, the future signal, right? So that is unbelievably bullish. And then I need to zoom in, but what's the one that's 0.39%?
That is BitFuFu.
Bitfufu. Okay, cool.
Yeah.
One of the miners I don't. Okay, yeah, there it is. Cypher.
Mm-hmm.
Cypher, every week at Compass on Fridays, we do the mining market update. And if you go back through the last 6 weeks or 7 weeks of mining market updates and you look at how Cypher finished the week, I would say 4 or 5 weeks in a row, they were 25% over week on week. And something growing at 25% week on week for a stock, that is that's ridiculous, right? Like you only see that in like meme coins. And it's not a shill for meme coins. I'm just giving you like the ridiculousness that can happen. So anyway, it's interesting to see that Cypher is all the way up to about 64%. Yeah, this is shocking.
Absolutely. And interesting, unique case for Cypher. If you see the institutions list in the upper right corner, you'll see the third entity, which is V3 Holdings. V3 Holdings solely owns Cypher. So you'll see companies held as one. The value of their holdings is all concentrated in Cypher. So they've taken a single investment into the Bitcoin mining sector specifically for Cypher.
Cypher's
And
one that, yeah. Sorry, go ahead, please.
I was going to say more generally, this is a big change in terms of sentiment, and I think it's a qualitative signal to be aware of, because the proportion of institutional ownership in equities underlying a Bitcoin mining company clearly point towards something that they see.
Yeah, totally. The due diligence is there, and I actually wonder how, since the launch of this morning, has even influenced some of the the mining mafia members, some of the people out there that are really just kind of like Bitcoiners. Maybe they own some MicroStrategy and TradFi. Maybe they got some Coinbase because Coin may just continue to run, and now they can get fold. That also came out, which is really kind of cool. But a lot of people are very, miners are very much into stacking their sats and then using some fiat to go out and play, in this with the guys that were at Power Mining Analysis, Anthony Power and Bryce. They're constantly doing analysis of this. I don't think I've ever seen them do an analysis or a breakdown of how much of the institutional or shares of these companies are held by institution. But I almost wonder if it's too much, having 17 out of 20 shares, being owned by the institutions with core, but I will leave that to more TradFi, TradFi minded people.
Absolutely, and it's something that we'll be monitoring as well going forward, because we do believe it's an interesting data point to be aware of.
Yeah, for sure.
All right, moving on. Secondly, in the PubCo world, an interesting development, which we talked about in our last episode as well, Jarrett, was around the adoption of firmware in the Bitcoin mining space. Most recently, two publicly traded mining companies announced deployments of Luxor firmware specifically, first being TeraWolf and the second being LM Funding America Inc., which has a Bitcoin mining subsidiary business located in the US as well. So firmware, what is it? Really, firmware is specialized software that is embedded into the ASIC machines, which essentially unlocks the mining machine and allows the user to take full control of how it operates. So firmware plays a crucial role in optimizing, specifically optimizing performance, efficiency, and maintaining stability for your mining machines. It is an interface between the hardware, the ASIC machines, and the mining pool and the software, essentially dictating how the machine processes mining calculations. So deploying firmware onto your mining fleet will give you a wide range of options and parameters to play with. We'll go through a few of them. First being your hashing operations. So the firmware manages each specific chip in your mining machine and ensures that they essentially hash efficiently. It also regulates power consumption and voltage to optimize performance and change the electricity costs that you can incur. Temperature control, firmware will monitor hardware temperature and adjust fan speeds or your hash rate to prevent from overheating. Firmware also facilitates communication with mining pools via Stratum and essentially ensures that the work you receive and the solutions you submit are valid shares. And then finally, with error handling and stability, some firmware, for example, Luxor firmware, will also detect hardware errors, for example, a dead chip or an unstable hash board, and it'll attempt to notify or mitigate them as they come up as well. Now, when it comes to public companies, the main reason why they are interested in firmware is because clearly the performance improvement that is unlocked it speaks for itself. And we can see this through this chart here. This is a spreadsheet that we've developed internally to run through and do testing for our Luxor firmware performance versus stock. And what I've done here is pick the quintessential mining machine, the S19J Pro. We know that it has a hash rate of 100 terahash per second. It consumes 2,950 watts, and it comes in at an efficiency of 29.5 joules per terahash. The table below is a summary of profiles, essentially presets of configurations, which Luxor firmware would give access to. what you can see is 6 steps downward and 2 steps upward, which means these are the profiles that you can use to overclock or underclock your Bitcoin mining machine. What this will do is change the amount of power that it consumes, or play around with the voltage and frequency, which will ultimately determine your hash rate and your efficiency numbers. So for example, let's just take an example here, and we'll take a look at the default setting when Luxor firmware is enabled on an S19j Pro. We can see that it'll consume 2,750 watts of power. It'll have a hash rate of 102 terahashes per second, and it'll perform at an efficiency of 27 joules per terahash. Compare this to the stock figures, which are up on the top left, and you can see that we have an efficiency gain just from the default setting of over 9%. And this will obviously change depending on how you choose to use your machine, whether you choose to do a heavy underclock or a heavy overclock, etc. But essentially, you now have access to a much wider range of hash rate and efficiencies, which will enable you to optimize your operation. So firmware really unlocks the next stage of optimization when it comes to dialing in your mining operations. And we can see that this takes place even at a scale of industrial scale, professional, publicly traded mining companies, simply because the performance numbers speak for themselves.
Yeah, before we go ahead, feel free to call out the headlines up there. I don't know if you've taken the time, because I think that's great news. It's great stuff.
Absolutely. Yeah. So these are 2 announcements that were made, as we mentioned, by 2 publicly traded mining companies that have deployed Luxor firmware as of February 2025. The first is TeraWulf. TeraWulf has deployed LuxOS firmware recently, beginning in February, and the second is LM Funding America. And both mining companies have seen improvements in performance similar to what we are showing in this table. All right. Before we move on to the next section, which is all about the forward market, another concept to keep in mind is most public companies don't necessarily hedge hash rate production. Although what we've seen is that over the past 6 months or so, it was generally a good idea to be hedging specifically against network difficulty and transaction fees. What this figure below shows is a hypothetical scenario of how public mining companies would have produced, how much Bitcoin they would have produced in January of 2025 had they fully hedged their production as far out as they could possibly have done, which would have been back to August of 2024. So if you were to hedge and sell all of your hash rate production in August of 2024 for January of 2025, you would have produced essentially more Bitcoin than you did if you were just exposed to spot hash prices throughout the month of January 2025. And we'll get into why that has been the case as of recent. But of course, we do need to mention that this can change and the picture can turn around and be the exact opposite as well. So this isn't necessarily about locking in and opportunistically mining more Bitcoin. It's more so around obtaining certainty and knowing exactly what your outcome will be, whether or not that is positive or negative in retrospect. Okay, any questions before I move on?
No, I mean, I'm to be fair, fairly new at this forward hash rate idea. So I'm always just interested to learn. And it is, you're saying, between August and January, if you had sold it forward, you would have mined, and I'm looking and trying to do some math, but 10 to 12% more if you're Marathon, somewhere around that, if you're Clean Spark, so on and so forth for Riot. It looks pretty the same for Bitfarms. Actually, no, it's a little bit more than 10%, almost 15%. But you're also saying that that's not always the case. And I guess if you could even speak to how big this market is, that would be interesting, because this really isn't something that Compass is near or deals with. This is totally a part of the of we help people from a minimum order quantity of one get some hash online, right? So this is pretty far away from what we're doing, but I would be also interested, what is the addressable market here? How many billions of dollars is being put on the line? How many billions of dollars were put on the line in August? And then people were super happy because they mined 15% more Bitcoin than they would have if they didn't do that in January of this year.
Absolutely. Yeah, great questions. On the addressable market, I would say, well, think about it. Bitcoin mining itself is a double-digit billion-dollar industry. And if you were to assume a certain percentage of that addressable market flooding into the hedging space, specifically for Bitcoin mining, you could then come about, to roundabout estimations, which I think is a fairly simple and intuitive way to go about it. But essentially, the addressable market is, as big as the hash rate market. So that's really the full scale potential. How far it goes will depend on many factors. But education is one of them as well, which is why we spend a lot of time walking through these calculations. We do a monthly analysis of the Look Back series, which is available on our blog at hashrateindex.com. And we also do private monthly webinar sessions specifically with enterprise grade mining companies and with the investor side of the industry as well, working with traditional finance executives and entities to educate them and provide an ongoing analysis at the end of every month for how hash rate market settled, what sort of contracts traded, what the performance was like, etc. So if anyone is interested in getting more information specifically around these concepts, definitely tap into those resources and you'll find a lot of good information there. So now let's get into it. Essentially, Jarrett, the reason why we've seen this big picture trend in selling forward, specifically in Bitcoin denominated contracts, making sense over the past 6 months or so, is because of this contrast that we see between Bitcoin and mining markets via hash price. The reason is because Bitcoin price, as we all know, has been on the upside, whereas network difficulty has also been breaking records. And then conversely, transaction fees are essentially rock bottom at the moment. So these opposing forces manifest in changes to hash price, which ultimately determines mining economics. And that's why there is this big divergence in outcomes, not only between Bitcoin and hash price, but also between US dollar denominated and Bitcoin denominated contracts in the hash rate markets as well. So this Bitcoin price effect is also showing up in the contracts as well, because they can be denominated either in Bitcoin terms or in dollar terms. This picture here really sums up why this is the case. So we've been seeing this again and again over the past few months specifically. What happens is that in US dollar hash rate markets, hash rate at the end of the month settles higher than traded in the prior months, which is what we're seeing here as well. And what that translates to is that anyone who bought or was in a long position would have earned a return because they bought low and they could sell it high. And conversely, hedgers would have seen a loss because they sell at a low and then they buy at a higher price. So they're having opposite effects essentially. So yeah, in Bitcoin denominated hash rate markets, we saw the exact opposite. January actually settled lower than traded in the prior months, which means that if you were to sell, you would have sold high and bought low. And conversely, if you were to have bought, you would have bought at an inoptimal level.
So looking ahead, this looks like a trend clearly, where the hash price in BTC may continue to go down, but assuming, this is a huge assumption, because basically back in September, like the first week of September, Bitcoin was like 60,000 and it was not looking great. It was just very bearish. Obviously, then in October, it really ticked up. And then in
Mhm.
November, it continued with, to be fair, the US presidential election really got people excited about markets and Bitcoin in general. But if Bitcoin price continues to increase, what would the move be? Because it looks like in dollar denominated, that's where you want to be. And that assumes that you're bullish on Bitcoin price. Is that right?
Well, so this is a good question, and we're going to get exactly into this
Okay.
because it. So it the first part of the answer is Bitcoin price may continue to increase, but
Mhm.
it really depends on hash price and hash price constituents. So just because
Right.
Bitcoin price continues to go up, we don't know how that will reflect on hash price, especially when we account for other factors, opposing factors, in
Right.
terms of network difficulty and transaction fees,
And
which will
difficulty.
ultimately,
Yeah.
exactly, which will ultimately set the direction for hash price.
Okay.
So that's actually what we're seeing here is there is this race between Bitcoin price versus other hash price factors. And so far, hash price has been going down, which means other factors have overwhelmed Bitcoin price actions upside to the point where hash price has been pulled down. Whether we continue to see this or not is an open question. But it's important to be aware that this is the case so far. Now, the second part of your question is you mentioned, if you're bullish Bitcoin, you want to stay exposed to the Bitcoin price action, but you may want to not be exposed to other factors of hash price, for example, transaction fees and network difficulty. So there is a way for you to achieve this outcome. In other words, remain exposed to Bitcoin, specifically the price factor, but hedge away the mining factors, specifically difficulty and fees. And the way you do this is by selling forward in the Bitcoin denominated hash rate contract,
Okay.
because that's the only difference between the Bitcoin denominated and the US denominated contracts, is that the US dollar also hedges for the Bitcoin price, whereas the Bitcoin denominated does not. It leaves you exposed while hedging you away from fees and mining difficulty. So, in fact, this was the overall punchline that we've been seeing repeatedly over the past 3, 4, 5, 6 months or so. Is the best strategy overall was to hedge away transaction fees and network difficulty, but remain exposed to Bitcoin price. And the way you did this was by selling forward in the Bitcoin denominated market.
Great breakdown. Thank you for that. I know that every month we talk about the forward hash price,
Mm-hmm.
and I'm starting to wrap my head a little bit more around it. And yeah, great. Thank you.
Absolutely. And we'll tie this all together as we go into the next slide. But before we do, I just want to point out once again, if we look at the red line here, the Bitcoin denominated hash price, we're seeing it from August to January of 2025, right? In August, it was higher than it was in January. So there's been a slight decline, and we see the exact opposite in the US dollar hash price. Hash price was lower in August, right around the 43 mark, but then in December of January, etc., we're at around the $55 to $60 range. Now, if I move on to the next slide, what I'm showing here is essentially a summary of how a 1 exahash mining operation would have looked like in terms of Bitcoin production had it done this, had it sold January 2025 hash rate forward all the way back in August of 2024. So we see a lot of green here, right? We see that the production delta is positive. So, for example, if you were to hedge 5 months ahead, you would have mined an additional 3 Bitcoin and you would have mined 17% more Bitcoin than had you just been exposed to spot hash price throughout the month of January 2025. Now, if we were to do the exact opposite and look at a table in terms of US dollar revenues, we would see a lot of red and we would see a lot of negative numbers. The reason being, again, going back to this picture, is because the US dollar curve settled higher over time. So it started off low, settled high. And then conversely, the Bitcoin denominated curve started off higher but settled lower. So when you're a hedger in these markets, when you're a seller, you get to lock in the price that you're selling at. And if you're selling high and then buying low, that's when you end up in a scenario where you're producing more Bitcoin and you're making a positive difference. So, this is quite complex and sophisticated, but at the same time, it really isn't, because it's just a matter of understanding how to interact with these contracts to express the objective that you're looking to achieve, which you can as a mining operation, and they tend to produce results, which we can see just by analyzing the market on a monthly basis. All right. Yeah. So summing it up, the best strategy was to hedge network difficulty and transaction fees, but maintain long exposure to Bitcoin, which a miner would have achieved by selling forward in the Bitcoin denominated hash rate markets. Now, even more fun around forward markets is it also gives us insight and information into what people are thinking in terms of expectations. The reason is because these contracts entail real money, so real stakes are being put on the line when these contracts are executed, and we are able to get these forward-looking expectations from market participants. So what did the market tell us throughout the month of January and in 2025 so far? What we've seen is that both curves traded in backwardation, which means that they were both sloping downwards. So the market expected both Bitcoin and US dollar denominated hash price to trend down into the future. We saw that contracts, US dollar contracts, fell over the first half of the month, rose during the second half, and then fell back down slightly, which you can see through the color coding going from left to right. We see that we start off with some green, go down to a red, and then back to a green, and we taper down to an orange yellowish hue. If we look at both contracts, both the US dollar and the Bitcoin denominated contracts, we can do a very simple calculation. We can divide the US contract values with the Bitcoin contract values. And what this will give us is implied Bitcoin price expectations expressed by the market throughout the month. And that's what we're looking at here in this picture. So we see a whole bunch of Bitcoin prices, and similar to US dollar hash price, implied future Bitcoin price expectations fell in the first half of the month. So you can see from the 6th to the 13th of January, the color code changed from green to red, which means that price expectations across the board fell down. They rose during the third week, and they tapered back down throughout the fourth week. Big difference here, though, is that at all points, implied future Bitcoin prices were in contango, which means that the market expected Bitcoin price to be higher in future than it is now across the board throughout the month of January. So again, we come to this interesting contrast, Jarrett, where the market is expecting Bitcoin price to continue upwards, whereas the market is expecting hash price to go downwards into the future. So combining all of this information together, we see that US dollar contracts are trading in backwardation. We see that implied Bitcoin prices are in contango. So this allows us to now take out another insight from the market's expectations. This is specifically around network difficulty and hash rate. If we think that Bitcoin price continues to increase, but hash price goes down, what this means is that we would expect both hash rates and network difficulty to grow faster than Bitcoin price and transaction fees. So Bitcoin price is growing, but hash price is going down, which means that other hash price components are overwhelming the Bitcoin price action to the point where hash price is being depressed.
How I always find that these numbers on this slide and the previous slide to be very conservative.
Mm-hmm.
And maybe that's just because they're based on math and not based on X hype and other things. But can you go back to the previous slide for a second?
Yeah.
So, here, even in January, where it's the most green and it's 104, I'm going to say 105,000 Bitcoin, to think that it only then goes up to 114,000 Bitcoin, which is only 5,000 above the all time, because I think the all time is 109, is
Mhm.
super bearish for a post halving year. And then going to the next slide, if you could go forward, we put out a poll on Compass, and I'm going to pull it up, talking about when we think people are going to, or asking people when they think the hash rate is going to crack 900 exahash, because the 7-day on the hash rate index, not even a week ago, was at like 855. It just shot up. And, 45% of people think it's going to happen in March. And 55% of people think it's going to happen, before the end of March, which
Mhm.
is way more bullish than that hash rate indicates. Now, once again, this is, asking the crowd here, and this is not, who wants to be a millionaire, but once again, between the Bitcoin price in the previous slide and the potential hash rate, it feels conservative.
Mhm.
But clearly what you're saying is like, look, if we're looking ahead and Bitcoin price continues to go up and everyone's bullish about that, but hash price doesn't move, then yes, one of two things, the hash rate and the difficulty have to be super bearish, meaning they're going to outgrow the price of Bitcoin by a large margin.
Exactly. And that's exactly what our market is expressing through the forward hash rate market. So, for example, if you take a look at the right here in trading days, we see on the 6th of January, the forward looking expectation for June of 2025 was a hash rate, a global network hash rate of just under 900. So, at 896 exahashes per second. So, that's the timeline that our hash rate forward market is expressing in terms of expectations for the 900 exahash mark. Now, on the 3rd of February, this changed a little bit. This decreased slightly, but was still relatively stable. And we know that the cold snap towards the end of January had an effect on this, which is why we see a bit of a disturbance. But overall, both difficulty and hash rate remained somewhat stable across the board, which again is might be relatively conservative compared to other estimates that we see online or through other data sources. But it's important to note again that these are real contracts at play being executed both with US dollars and with Bitcoin at size and scale. So it's a true high stakes game, which is why we take these expressions as high signal data points.
I have a question about the hash rate. Do you know if that's
Mhm.
3 days, 7-day? I think there's even 30-day moving at, like, when we look at that, when I'm looking at 896 or 879 for June, is it
Mhm.
which of those is it? Do you know?
This is actually a static standalone number because it's a manual calculation that we're getting by inputting a transaction fee assumption.
Gotcha.
However, you could extend this to a 7-day or 30-day average. This is a point in time single digit that we're coming up with, though.
Perfect. Perfect.
All right, and that brings us to the end of this session. Right before we close off, this is what our forward hash rate market is looking like right now. So the market is pricing in an average hash price of $54 or 55,000 Satoshis over the next 6 months. And with that, I will turn it over to you, Jarrett, for any Q&A.
I have not seen any Q&A come through. I haven't seen too many comments, which is either a really good thing or a really bad thing, but I think it's probably a good thing. I think today we dove a little bit farther into some of the slides,
Mhm.
and I'm always trying to be as curious as possible here, because some of this stuff is just new to me. There's so many parts of mining and some of these forward hash rate numbers and statistics, and just the way that game plays. It's almost like I understand all the players, but I don't know how they play. All right. I'm looking
Mhm.
at the chessboard. I understand what the rook does and the bishop does, but I haven't ever really played the game. I understand difficulty. I understand hash rate. I understand Bitcoin price. Understand the idea of the constituents of hash price. But when you put that in and then you basically are putting puts or calls on it, it just changes the game tremendously. And I think miners are constantly thinking about the dollar denominated hash price versus the Bitcoin denominated hash price. And that really depends on their strategy. Are they going along with this and still using fiat? For the person that has two S19s with Compass, are they just using their fiat machine, their job, or something else, or some real estate to pay off, and they're stacking that Bitcoin, or are they actually cashing out the Bitcoin month on month and trying to make the game work? And I think that it just depends on the strategy. So yeah, thank you for bearing with me there and being patient, because these things are just new, and this just speaks to how deep mining is. Every single day I'm like learning new things and trying to see the world a little bit differently. And like I shared with you the Atom thing, I just love that. Whatever you're mining, whether you have 2 machines, 3 machines, for some people like Clean Spark or Riot or Core, they end up mining a lot of Bitcoin per month. If they break it down to a day, they may be mining the Bitcoin block reward per day because of how much exahash they have online. And so thinking of it that way, and then zooming out like Adam did and said, you know what, I have 3 S19 XPs, which what I'm getting weekly is actually the block reward in 2060 something, in 10 epochs ahead, 40 years ahead is really quite cool. So I think that there's just so many different ways to think about the value of mining, right? And whenever you're thinking about something, there's the cost, the price, and the value. And the value is really what you're going to get, right? The cost is what you're going to have to pay to put into it, and the price will be the product. So it's just fascinating, and thank you for being patient today, because I feel like I was asking a lot of questions that may seem obvious to you, but we're just doing a little bit different things over at Compass.
Absolutely. Great session. Thanks so much.
Yeah. Anyone watching, will be on, I think we're doing the third Wednesday. The January really threw me off because it was January 1st was on a Wednesday, but we'll be doing the third Wednesday mining metrics. We will be back on in March. And let me just say the date out loud on mic. That's going to be the 19th. Once again, today's the 19th, and we'll be back on the 19th. And we're trying out this later hour. Hopefully it fits with people's schedule a little bit better. We used to go at noon Eastern. So, leave comments if you enjoy that. This will also be up on YouTube once we sign off here. And this will be up tomorrow on the Compass Mining's YouTube. And will, I think, be on Twitter, Twitter X seems to have a lot of stuff live for a lot longer. I think it's 60 days now. So hopefully you'll be able to come back and reference this. And I'll also leave on the YouTube Kaan's information, my information, if you want to reach out. This has been a collaboration of Luxor and Compass. Kaan, thank you once again for taking the time today.
Absolutely. Thanks so much, Jarrett. See you next time.
Thanks.